here we are. We are at the end of Project 1. You guys have this one more assignment to complete, assuming that everything else is done. As a reminder, please go back and read feedback. If you have not received a grade in for an assignment that you did submit, okay, and I've corrected or evaluated it, it probably means I left you some feedback that needs to be corrected. Okay, so you have to go back and read the feedback, make the corrections, resubmit it to that same Dropbox. Okay, until you get grades for all of those, Project 1 really won't be completed. And I probably won't give you subsequent grades, like for this final assignment, if those early ones are not completed. So what we have now, what we have left anyhow, is this cash flow and balance sheet due this Sunday night, as most things have been due. Okay, and let's take a look. I've kind of put in a few numbers, just kind of garbage numbers, but just to make some points as we go along here. These two statements that we're going to be looking at, the cash flow, there's two cash flows, and the balance sheet, there's not a lot of input that you're going to need to put into these. Relatively easy, but there are a few things that we need to do and a few things that we need to look for. Okay, as you can see on the cash flow for year one, there are only 4 rows of the orange cells that you might make entries to. So, and actually, there may only be 2 of those, 1 or 2 of those that you would actually make entries to. And let me go through and explain. So, additional inventory. This program basically assumes that as you build your sales, your inventory is going to increase with those sales. And it's basically a part of the cost of goods sales, cost of goods sold equation that you have on your sales projections. And so generally speaking, you wouldn't need anything here. Okay, if you're a seasonal company and you wanted to bump up some inventory before golf season, say, or those types of things, maybe in the month before that. But again, the program kind of assumes that and kind of replenishes. I guess it assumes that you're replenishing your inventory as you go along. So there isn't really a need to put anything in there. Again, if you've got a special situation, you may choose to do so. This one, absolutely. Okay, owner's distribution. This is where you pay yourself. This is why I told you back here on the payroll, you don't pay yourself anything there, because this is where you pay yourself. You remember in virtually any entity except a Schedule C corporation, you're going to pay taxes on the full income or get the benefit of the loss, I guess, for the full year's profit or loss for that company, right? So a distribution is just that. It's taking some portion of that income. Sometimes, and believe me, I saw that happen too much, where the owners took too much, more so than what the company made. And of course, they usually didn't last very long if that was the case. But everybody needs to pay themselves something, right? I had a lot of, when I was in banking, and we'd submit applications to the SBA for some guaranteed loans, which they don't do it that way anymore. But anyhow, had a lot of them sent back that would say, if the owner's not paying themselves, this isn't going to work. And the only time sometimes we could bypass that is if the owner's spouse, maybe had an excellent job or something like that they could live off of. But the SBA expects that if you're going to start a business, you better have the means to live, or else the business isn't gonna last. So in my case, I'm going to put in a small amount. And for some of you, if this is going to be a part-time business, a small amount's probably okay. Nothing wrong with that, right? If it's a full-time business, you ought to be thinking about something that, could provide you with a living. If it's not enough money, which, we'll look at the cash flow and the income statements. If it's not enough money, you may have to go back and bump that up, and you may have to go back and reevaluate your sales projections or your expense projections. So I'm just going to carry that across. And mainly what I want to do is show you some things down here at the bottom, and that's this, okay? So, because I'm showing here I don't have any sales for the first few months, okay, and I'm going to have some sales that take place here Okay, got some accounts receivable, got some stuff going on, but I'll have some cash coming in, but for the first, I got operating cash balance, negative, so I've got a line of credit that kicks in and a line of credit, still a line of credit. I'm finally a little bit positive here, a little bit positive there, but not enough to pay back. And so I'm starting to accumulate a little bit of cash, and I don't want this interest to be accruing much anymore, so I might try to pay this down. So I can come up here, I've got $1,800 in cash, maybe I'll pay it down by $1,000, right? Okay, now my balance is my cash balance is 803, and I've paid this down to 1,763. And look at that, I still got plenty of cash here, so I could pay that down even more. Kind of like to leave a little bit in my account. Maybe I'll just pay another $1,000. Okay, now my balance is down to 763. I've got plenty of money here. I'm just going to pay that off. So I'm going to put in $763. And there I go. Now I have no line of credit balance. Be sure that you do not have a line of credit balance. It's okay here, to have a line of credit balance. I get that. A lot of businesses start that way. Okay, they might need a line of credit with their bank or other financial, type of an institution to cover those early expenses. But as the business goes on, we should project, that we can pay off that line of credit and that we're not going to be indebted to the financial institution forever. So there, now I'm clear. Okay, I got my, I'm paying myself. I got that. Dividends, probably not. Dividends are normally paid by a Schedule C corporation, and if you did set up a Schedule C corporation, which none of you in your businesses, made that claim that that's what you wanted to do, so you wouldn't pay a dividend then. Okay, if you want to give yourself more money, you can just do it up here in owner's distribution, right? You wouldn't, if it's a non-Schedule C business, you really wouldn't do both, because this is basically the same as this in a non-Schedule C type of a business. Okay, some exceptions to what I'm saying, so don't take that as carte blanche, but for the most part, what I'm saying there is correct. If we come over then to year 2, okay, I'm kind of doing okay. I still don't need any inventory. I'm kind of looking down here. I could pay myself a little bit more maybe this year. I'm going to pay myself $800 a month. Okay, and I can stretch that out. Okay, you need to make sure that you do years 2 and 3. And I still don't have a line of credit balance. I still actually have a cash balance. I came kind of close here, so I got to watch. Again, if in the second year, if there's a month where maybe I got a seasonal business where I incur a line of credit, okay, as long as I can pay that off later, but be sure that you do that. Okay, then I got to come to year 3, kind of look at that. I might be able to pay myself even a little bit more here. I pay myself $1,000 a month. Okay. And I can stretch that out. I might even at the end of the year pay myself a little bit more than that, right? Because I could, right? I got cash, no line of credit. Okay. I didn't need any additional inventory. That's it for the cash flow. Okay. So now it's time, the income statement, let's just take a quick look at that. Look at that. There are no orange or even yellow spaces on there. Nothing for me really to correct. Okay, or to change, to add, so I can leave this blank. But what I want to do is take a look. Okay, I got a net profit or loss, and I'm looking for this to be at least a positive number. In the first year, if it's slightly negative, we might live with that. Okay, in our first year's projection, that again is not terribly unusual. We'd kind of like to see it be a positive number, at least somewhat positive, slightly positive. And in my case, $4,500. So yeah, okay, I can kind of live with that. I'm going to hit years 2 and 3. Oh, nice. Okay, I got slight improvement in each of those years for my income. I'm okay with that. Okay, and again, years 2 and 3, no yellow, no orange spaces or gold or whatever. So I'm good. I don't have to make any changes on there. But now let's take a look at the balance sheet. Okay, and I'm going to come down here to the. Oh no. Look at that. I got warning not balanced. Bugger. Well, what do? Well, I'm going to scroll up and show you what to do. Okay. You can see I got prepaid expenses and other initial costs here, and that's a minus 2,500 minus 2,500 or a minus 5,000. Look at that, it's the same as that. And I come over here to year 3, minus 5 and minus 5, which would be minus 10. Oh, that equals minus 10. Well, what happened? Well, I made you guys change that additional inputs here to 1 year because I thought that was a more appropriate time frame to write off our initial expenses, prepaid expenses, right? So I got prepaid expenses or other initial costs, okay? So what I need to have you do is take these 4 cells, and you can highlight them like that and hit the old delete button. Oh, guess what? I gotta unprotect the sheet. Okay, so I do that. Remember our passwords 1, 2, 3, 4. I had to hit review, unprotect 1, 2, 3, 4. Hit OK. Now I've got those still highlighted. I can hit my old delete button. And guess what? I'm balanced. I'm good. I'm done. I'm going to submit this now and get my grade and celebrate that project 1 is all said and done. So good luck on this. And again, as always, let me know if you have any questions. Take care and congratulations on finishing project 1.